we are going to, dive into pairs trading. So this is a really unique and fascinating way to trade. And so, again, thanks for being here. A little, background on myself. I've been actively trading now. Wow, I don't want to say I started my trading career or journey back in the 80s with a company called Coastal Corporation, and that was a great experience. I was able to get in the door there, and they actually had a training program where they would, train you to teach, oil products, crude oil, all that kind of stuff. They were a big integrated oil company, and out of Houston. So was able to get into that program, kind of out of college. And they sent me down to one of their refineries they had in Corpus Christi, Texas for about 3 months, which was kind of a foundational learning experience, kind of get your, understand the foundation fundamentals of, how the oil, market works as far as bringing in crude oil, shipping it in, putting it in a refinery, and then putting out the product. So it really kind of gave you that foundation, which was great. So then I ended up in the shipping department, which I really liked, do tanker chartering and operations. And then finally got into onto the foreign crude oil cargo trading desk in Houston. So was really excited about that. It was huge. We had a huge trading group, products and crude and all that kind of stuff. But I was on the foreign side, and they sent me out to Singapore for a couple of years and traded products, fuel oil and jet fuel, all that kind of stuff, and Asian crudes. And it was just a fantastic experience there. And beautiful place. If you ever get a chance, make sure to check out Singapore. It's pretty awesome. And then I got my big, huge break in my career back mid 80s. I was got a job that offered at a company called Transworld Oil, and they were at that time the largest oil trading company in the world. It was Transworld, Febro, and Mark Rich, and so it was just unbelievable. So went to work there. They had a Houston office, but then immediately they sent me out to Bermuda, which was a corporate office, and spent about 16 years in Bermuda, which was their corporate office, and then ended up with the trading group for 10 years, the international trading group there. And basically that's where it was just, really amazing. We traded everything, from all the different energy sectors, crude oil, fuel oil, natural gas, and then all the different securities, foreign exchange and futures and all that stuff. So great experience. That's where I started trading options back in about 1987. We got pretty big into the option side of things. But the main thing that we did was everything was really centered around pairs or spread trades or pairs, and that's what's something that's missing in a lot of people's trading portfolios. So that's what I'm going to kind of touch on today and see what you think about it. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, today, we're going to dive into, what I think is one of the most powerful yet really underutilized trading strategies in the equity market. So it's, pairs trading or spread trading. So in a world where the markets are increasingly volatile and unpredictable, this strategy really gives a trader a unique edge. So it gives you the ability to profit regardless of market direction. So you're not subject to those overnight big moves up or down, which are, pretty terrifying at sometimes, pretty nerve-wracking. So instead of just trying to call tops or bottoms, pairs trading will focus on the relative value, capitalizing on price divergences between two correlated stocks or securities. So whether you're looking to hedge your position, generate more consistent returns, or simply expand your trading playbook, this strategy can be a real game changer. So, back when I was running the trading group and back when we were trading energy, which is pretty heavy on the energy side, pretty much everything we did was some kind of spread. We would do front to back spreads, which were what we call timing spreads, where we would, sell oil or buy oil in 1 month and sell another month to hedge it. Or we would buy oil, sell gasoline against it, or buy gasoline, sell oil against it. So we were doing all kinds of spreads, but they were all based on some type of relative value between two kind of somewhat correlated instruments. So it could be like we were doing crude to gasoline, crude to heat. So those are correlated, right? So that's what we can do. Now, here's a really good example. So let's say that the S&P 500 was to fall 20% in the next year. Now, how will your stock holdings perform? Or let's say the S&P 500 climbs 20% in the next year. How will your stock holdings perform? But what if you did have a trading strategy that allows you to make good money, even sometimes great money in either of these scenarios? So you could do it in a bull market, you win; bear market, you also win. So pairs trading is that kind of strategy. So it's basically a market neutral strategy that uses pairs or spreads for all the trades. So it really offers you a unique way to play and trade in the markets. Now, essentially, a pairs trade has an equal chance of generating profits regardless of the whether, the market you're trading is going to go up, down, or, remain stable to sideways. So it doesn't matter. So this approach involves pairing a long position with a short position in correlated assets, which may include two stocks, exchange traded funds, ETFs, could be currencies, commodities, different oil type of products together. Now, pairs trading that identifies what it does is identifies a strength or weakness in a correlation, taking a long position on the security that shows more strength, while at the same time shorting the weaker one, and then closing the position out as those relationships move back to kind of the statistical net average or norm. So the profit from the strategy is realized from the disparity in price movement between the two instruments of the spread and not the overall directional market. So there's no systemic risk when you're trading pairs or spreads. Now, the big reason hedge funds are called hedge funds is because pretty much everything they do is somewhat hedged. They're doing pair trades. That's what they're doing. And so you may have been hearing, the bond market is going through, some pretty big experience here as far as, bonds are, the futures have been selling off, pushing yields higher. Well, those are pairs trades. So the huge trades were put on where the players were, short the cash bonds and long the futures. And then these, the relative performance or strength of that pair started to shift where they were getting stopped out of their short cash and having to sell off their futures in order to cover those positions. So those are pairs trades. So the exact same thing. So you can do it on anything. So it's a market neutral trading approach designed to mitigate specific market risk by establishing offsetting long and short positions in the related instruments. So, whether real or theoretical, you're going to profit as long as your stock or security you purchase performs better than the one you short. So the greater the difference in the performance, the more profits you're going to earn and make, independent of the overall market direction. So, consequently, then pairs become really an excellent method for generating income while avoiding extensive market risk and avoiding that systemic risk that can, come out from certain different headlines as we see all the time currently. Now, the reasons to trade pairs, we can go through a couple really good reasons here. Is first off is risk management. So, one second here. Risk management. So utilizing trading pairs or spreads can effectively lessen your overall market risk. So by taking those opposing positions on related securities at the same time, you can decrease exposure to wider market fluctuations. So this strategy is especially advantageous in volatile markets like we're in now, where abrupt price changes may result in considerable losses. And a lot of times that happens overnight when you have, no chance to kind of position or hedge out your position. And the other thing is sector rotation. So you can leverage pairs or spreads to capitalize on trends within particular market sectors. For example, you might choose to go long on a security in an industry you anticipate will thrive while shorting a security sector or something that you think is going to really lag behind. So it can be a great way to take advantage of that kind of sector rotation between strength and weakness. Now, the other thing is hedging. So as an investor or trader, you can employ pairs or spreads as a strategy to protect against, possible losses. So by establishing positions in correlated securities that typically move in opposite directions, you can balance out your portfolio in one asset with the profit from another. You might be long some sector, long maybe a lot of NASDAQ, and you might want to offset some of that sector by, or let's say you're long NASDAQ, you might want to offset that by shorting some other sector, that's going to complement it or diversify that potential hedge on that. So a lot of different ways that you can, do this kind of hedging. And then diversification. So by utilizing pairs or spreads, it's going to enable you to diversify a portfolio across various securities while still adhering to a targeted strategy. So this approach then can really help mitigate risk, improve, overall potential returns. And the other thing, they're really, once you get into spreads, they're really fascinating. It's really, you have to use your head to figure out a good pair correlation. And actually, they become a lot of fun to actually trade. So first we get, before we get too much further, I thought we'd do kind of a market review and kind of go through the markets, and I'll show you kind of my outlook on everything. And so we're going to do that in what I call kind of a top-down market analysis. So, back, in the oil markets when I was running the trading group, we didn't have really, charts and everything. So all of our analysis was basically fundamental. So what we would do is we would take the fundamental outlook from all the various offices that we had around the world, and we get that big macro picture, and then we can develop our trading plan off of that, for longer term down to short term. But now it's great because we have great, technical analysis and things like that. So currently, this is the S&P 500 SPX, okay? So this is kind of pretty much the reference guide that most technicians use, is the S&P 500 SPX. Now, these are my indicators that I use. These are momentum-based indicators. So this is, the way I trade based on momentum, and these can give us a really big outlook and also a correlation of what happens in the past and what we can maybe look at for the future based on these charts and based on momentum. So just kind of a quick summary, this lower study 1 is a really fast momentum measurement, and then lower study 2 here is a slower momentum. So when those two are aligned together, that kind of confirms the overall trend of momentum. So we have momentum trend, and then we will have price trend. And then the other indicator that I use is my cycle reversal indicator, which is this third one down here. So just to show you that plus Fibonacci, it really sets up a really good system that you can analyze the markets with. So basically, here's the macro based on the monthly time frame. So if you look at this, the last big major swing low we had was back there in October of 2022. That was the big kind of the correction we had, that you should be aware of, 2022. And then we had a really nice, great trend up from then, for about 3 to 3.5 years. Now, what you're going to see here is that the cycle 1 lower study momentum is negative. Okay, so we had this pretty big move to the downside. Now, you can also see we had a cycle reversal right here. So what you're looking at here is then when you look at the retracement levels from this swing low to high, it almost to the penny stopped at that 50% retracement at 48.15 basically, okay? So very big key technical level, plus that's also what we call the big price action support area. You can see where price went up here back in 2022, I think it was right here, and see that's where it fell off. So that's also what we call price action support, which also aligns right there. So it's a perfect place for the markets when it stopped. It stopped right there. Now, what it needs to do though, cycle 2 is still positive. So this potentially could be just a shorter kind of correction to the market. So if I look back here and look at this, the last time we had it where we had cycle 1 negative but 2 stayed positive was back in 2020. All right, so this could be something similar. So this is kind of a policy correction, not a financial crisis like we've had. We had a lot of things happen in 2022, but you can see 2020, we had negative momentum on cycle 1, but 2 basically stayed positive. All right, now 2022 though, we had negative momentum cycle 1, and then you can see 2 went negative, and we had that bigger correction. So, this histogram is showing really negative momentum in 2022, and then we started getting cycle 2 going negative, and that's when it really corrected. But right now we're in that correction phase. We stopped initially right there at that 50% retracement. We've had a short covering bounce retracement rally back up. And then if we break it down and go to the long-term time frame, so the weekly, you can see where we are there. We stopped right there at that 50% retracement, but another really huge major support level are these 2 key moving averages. You've got the solid yellow as the 150 period, so that would be a weekly, and then you've got the 200 week. Now these are 2 really key moving averages that hedge funds and the markets follow. So another big support level there. So there's a lot of support here, a lot of price action support coming in this area here. So it's going to be hard initially for that to break. So we did test the 50. Most likely, technically, you're going to tend to come down and retest. But with this major support below it, this could get enough, support to hold that level. That's what I'm looking at initially. Now we've had a retracement bounce going up. So again, taking our Fibonacci levels from that swing high to swing low, you can see we're close to that 50% retracement. And typically that's where you tend to fail, is at the 50, or if we get a little bit more move, the 618 up here. So then we break it down to the daily time frame, which I call the medium term. And you can see that it's kind of like taking off, you're in an airplane about 30,000 feet. You want to kind of see more detail, so you kind of go lower. So you can see we've had a bounce back retracement rally back up here. That dashed green line, if you can see it, that's the prior week's high. That's the 21 exponential moving average. So the market's stalling, struggling there. So this is key next week to see if the market can chip through and break this level here. If not, it's going to roll over and retest that prior low. Now that's going to be the real test to see if that prior low or in that area can hold, which has all that moving average support below it. So there's a good potential it could. The other thing that if we do break this level, then the big next retracement would be up to that 618, about 5640. And then this is huge resistance. This is where you definitely want to take retracement shorts, just to look at that potential upside resistance. So a lot of supply trapped up there and huge amount of resistance there. So that's kind of an overview there. Now, as far as the market kind of psychology of things, next week we're going to have, basically Trump, they're trying to negotiate a lot of these deals. So you're going to probably see more kind of positive headlines coming out of the market about, how things are going, that, a positive spin. So, Trump likes to talk positive. He's very positive as far as, talking about things. And right now his agenda are these, different negotiations, which they have going on with Japan, Korea, Mexico, and the EU, et cetera. So they're currently in pretty big talks with Japan and Korea, and they're going to be, talking positive that things are looking good. Now the fruit will be, though, can they close the deal? So, but next week you'll probably see more positive headlines. That's kind of my spin. So we could get a little bit more, push to the upside, and then go from there. So that's kind of an overview on what I'm seeing there. Now, the next thing I'm always following, and very important, is to kind of follow seasonality. So this is another really great thing as far as giving support or weakness to a market, because there's so many seasonal components to a market, based on supply, demand, and different seasonal factors. So this is a seasonality continuation chart on the S&P 500 for the September contract. So we're pretty much sideways. You can see we're currently right about here. And so really just not, just really goes nowhere until you get here towards this May period. And then we have the potential for a pretty good rally, especially on the NASDAQ, which we'll see next. But right now, we're not, in a period of really strong seasonality. This is kind of a transition period, getting into kind of the, May, period into June, July, that period. And then you see a little bit more upside movement seasonally. So you can really see it more so on the NASDAQ 100. So here's the NASDAQ, and this is also the September continuation series here. So we're currently right here. So this goes back, the black is 15 years, red is 5, and then 29 years on that purple magenta. But you can see that, you know, we have a tendency over the last 15 years, the seasonality has been kind of pretty sideways. On the 5-year, you can see it's sideways to down. And then, you know, you can see pretty much sideways here on 29 years. But it does tend to get a pretty good cycle low when you get around this period right here. This is like the 12th of May. All right, so let's say mid-May. And then you have a pretty decent potential seasonal trend to the upside that's pretty much happened on all those different years, you know, the cumulative 5 years, 15, 29. So that's a look on the seasonals from the NASDAQ. So the NASDAQ is potentially a little stronger. Seasonally, we'll see if that falls through, but I like to follow that. A lot of times it's, you know, what I call, you know, having the wind at your back than it, you know, than in your face. And makes the market trades a little bit easier if you've got that component. Now, then the other thing I always like to see is, okay, where's energy? What is it doing? So here's the continuation chart for the August group. And so you can see we're pretty much, we get that cycle high right here around the 15th of April. And we're currently right about here. Now we tend to get a potentially a pretty decent pullback. You can see over the last 5-year period, we've had a pretty good pullback. And you can see the other years have been kind of sideways to a little bit down. Now, once we get into around the early part of May, though, we tend to get a seasonal rally. And a lot of that goes with, you know, refineries picking up, runs increasing to, you know, start manufacturing more gasoline. But, you know, that can change. We've had, you know, less gasoline consumption because of the EVs. Plus, if demand gets hit with, you know, tariffs, we get demand destruction. That'll probably be less as well. But that's just a look, you know, from past, you know, seasonality statistics there. So that's kind of, you know, something that you can look at and hang your hat on to see what's going on there on seasonality, on correlation. All right, so we want to identify 2 securities that have kind of a historically strong correlation or relationship in price movement to each other. So these securities could be from the same industry, a sector that they're in, or a market. So there's some kind of relationship that they have, something in general, right? So the correlation that indicates, yeah, the top-down question was the top-down analysis, yearly, monthly. Okay, I'd use a monthly, then a weekly, then a daily. Okay. So each bar would be a monthly, then on a monthly, then on the weekly, each bar represents a week. So what we're looking for is either positive or negative correlations. So we want something that has some positive correlation, okay? So typically what you'll see is that if you have a correlation, it has to do with a low, so how the pair moves in the same or different direction at the same time. Now, statistically, the correlation is a measurement of either going to be plus 100 or plus 1, which would be very highly correlated. So they move almost exactly together. So these are not ones that you're going to typically want to do a pairs trade on. If they move too close together, there's no divergence, there's no spread to trade. All right, so you want some kind of you know, correlation that's not 100. So that is you know, what the bond trade thing, you want to have some kind of correlation. Now the cash bonds and the future bonds have been really tightly correlated, so that's why but they play the little bitty spreads. So that's why these hedge funds, they just do, their positions are huge. It's all based on volume, but it's been a really accurate spread. But as you go into maturity, but they're having problems right now. Just kind of point that out. But we want a little bit of difference in the correlation. So we want, if we want, you know, plus 100, they're going to be tightly correlated. If they're like negative 1 or so, the asset one will, you know, it says that one would go up, the other one's going to go down. All right, but we want something in between. So when you look at 2 stocks or indexes as a potential pair, I kind of start out with 0.60, you know, 60 or 70 or higher correlation is a good place to start. You don't want to get too much below 60 or 70. All right, so the sweet spot is about 70. So if the correlation is lower than that, the relationship between the 2 securities may be too weak to really get get a good trade, to pair the relative value, to trade that relative value. So think of this, like let's take a look and think. So for example, let's take a good example here. What has been really strong lately versus, I tell you what, one thing that's been pretty good is, we'll just kind of play like, Walmart's been relatively strong, right, to the market. So here's a good example. So let's say stock A, and we'll say Walmart, and stock B, we'll say, the S&P. So it has some correlation, or we could say XRT or something like that. But let's just say that are highly. Well, I got a good one here, and I'll show you if I have time. I'll show you this correlation in a minute. So let's say we'll do Costco versus Walmart, right? So let's say we have a stock A, and we'll say that's Costco, and then we have stock B. We'll say that's Walmart, and they are very correlated, right? They're in the same sector, that retail. They're just big, huge, mammoth, just relative value as far as good pricing and just big, bulk stuff, So very, very tied together, right? So let's say if the correlation then weakens temporarily, and then stock A moves up, say stock Costco starts moving up more, then maybe Walmart stock B moves down. A pairs trade may be able to exploit this divergence by going long stock A or Costco, the stronger one relative value, and then shorting Walmart against it, which is underperforming. So then you can see here, this would be stock A. You can see it starts moving up, but stock B starts either moving sideways to down. Now, as that spread widens, that's where you make your money. So it doesn't matter. The broad markets could be going down, which they are, right? But the spread on this, the strength and the relative strength, or the value between stock A or stock B, could be, increasing and diverging. So, Costco could be moving up a little bit more than Walmart, and that spread widens. So that's where you make your money, on the relative spread. So it doesn't matter if the market's going down, the market's going up. All you're playing is a relative spread value between those two securities that have a correlation together. So the central pairs trading is the idea that if the two stocks or other instruments are correlated enough, any change in that correlation may be followed by a reversion to the pairs back to the kind of the norm, creating that profit opportunity. So, I'll look at correlations of 60, 70 or above, and 70 kind of beat 70, 80, 90 being the kind of what you're looking for as kind of the benchmark for your pairs. Okay, so that's what we look at now. I've got kind of a calculator that I use kind of to give me this correlation. So here's an example of just two securities that are in the same pretty much industry. So you have Goldman Sachs and JP Morgan. So their correlation coefficient, based on my calculator, is about 0.91. So they're very tied close together, right? So very, very correlated. But you can see from time to time that correlation will change, and you can see Goldman Sachs is kind of blue. You can see it tends to widen a little bit. See that correlation changing, especially right here. So these are things that you can take advantage of. So you may have been long Goldman Sachs versus JP Morgan or something like that. And you can see then even in a downtrend, you can see if you were long Goldman Sachs, it went down, but it didn't go down as much as JP Morgan. So you would have still made, if you're long Goldman Sachs, short JP Morgan, you could have made the spread, or it could have been the other way around. So that's what you're looking for. So, and it doesn't matter what the broad market's doing, which is so nice to have that, where you can, go to bed at night and you're not, too worried about a position. All you care about is that strength between the two securities you're pairing together. All right, so here's a little bit more insight to that. Here's Goldman Sachs, and this is a 1-to-1. So, this would be like you'd be long one share of Goldman Sachs or 100 shares, and then short one share JP Morgan or 100 shares. So it's a 1-to-1 pair correlation. And you can just see these are my indicators. And so you can see here's my cycle reversal indicator, here's momentum indicator, and you can see here, that here's the cycle reversal. So this is Goldman, this would be like Goldman Sachs and versus JP Morgan. So you can see that relationship really started to move down. In this situation, Goldman Sachs, the spread between it and JP widened really big, and then the spread started to move back the other way, where Goldman Sachs started to outperform JP Morgan. So those are things that you can play, but and we'll take a look at a few others, but they're really a great way to trade. And the pairs, you've got, like, again, no systemic risk. Yeah, I'll show you. I have a scanner that I use to kind of help select pairs. I'll show you that in a little bit. So that's a look there. Now, here's the deal. Here's really what's exciting about a pairs trade, or if you want to call it a spread trade, is that pairs or spreads, you can make money 5 different ways, right? So if you think about it, we'll go through the kind of scenarios. But if you're just a long short player, right, you can only make money if whatever the security you buy, you can only, if you want to go long, you want that security has to go up to make money, or if you go short, you have to have that security go down. But if you have a pairs trade, you can make money 5 different ways if the value between the two are correlated enough. So let's say, for example, we were looking at Costco versus Walmart. So let's say that the Costco starts to go up faster than Walmart. So it starts to move up faster, and Walmart's going up, but it's not going up as fast. So that spread is widening. See that spread widening? So, if you bought the spread here and you just had the spread long, say you bought that spread there for $100, maybe Costco is $100 over Walmart, and then that spread starts moving. Costco starts really increasing in value. Now Walmart's going up, but it's not going up as much. And now that spread is maybe $200, where now Costco is now $200 over Walmart. But it doesn't matter. But that's all you're playing is the spread, even though Walmart's going up, but more slowly. But you're playing the spread. And so these are a lot of fun as well. Or the other scenario might be where, Costco goes up, but Walmart goes totally sideways. So that's even, a better situation. So that could definitely happen. I mean, it depends on what you're, looking at. So Costco could be going up. Walmart could be going sideways. Look at that spread increasing. So maybe you started out $100 and now that spread is $300, right? So you've got $200 profit in that spread. Even if the market's going down or sideways, it doesn't matter. You're just playing that spread. You could care less about the market. You're just playing the relative strength and weakness between those two correlated instruments. Or we could have, Costco going sideways and Walmart going down. So Costco could be just going sideways, and then Walmart starts going down. So now you can see that spread widening, right? So you've got that scenario. Or you could have Costco going down more slowly than Walmart. Walmart goes down faster, and Costco goes down, but it's not going down as fast as Walmart. So Costco starts going down, but Walmart really starts going down faster, and you can see that spread widening. Or the other best scenario would be if you've got Costco going up and Walmart going down, right? And then you've got that huge spread. So these things are, potential to make really big profits, but they're also, going to give you that hedge for any systemic risk. And in this kind of market environment, that's that can be a real game changer for your portfolio. Now, the other really cool thing, and this is what I'll really get into more in the course, is we can do these pairs trades using synthetic options. So we can do it synthetically. So we don't have to go long the shares or short the shares. And a lot of times, if you shorted shares, you've got to basically be borrowing the shares to short. In some situations, there are not going to be any shares to short. So in the course Saturday, I'll teach you how we're going to do these pairs trades where we're long short, but we're going to, instead of being long short the equities or whatever security we want to trade, we're going to be long options and short options to replicate the exact pairs trade. Okay, so it's a really cool way to do it, and it's much more efficient. I'll go through a little bit more detail on it in a little bit. So this is going to be then mirroring the underlying stock or security you're pairing. So this is going to lower your trading costs and ends the hassle of borrowing shares to be short. So that's a really great way to do it, and that's what we're going to cover in great detail in the course, which hopefully you'll sign up and take advantage of. Now, the next thing is what are suitable pairs? So the first step is we want to find those pairs to look for securities that have something in common, that trade and also have good liquidity, so they can be, shorted. But again, we're going to be using options, but that's typically what you're looking at. Now, we want to be similar markets, the risk, of that. So could be competing companies within the same sector, make natural potential pairs typically, okay? Competing companies are great. That's one place to look. Or another place to look is kind of, you look at the companies in a sustained long-term trend that make a good stock, and then you pair that with a correlated stock or maybe a correlated ETF within that sector. So that's another really great way. That's the way I like to do them a lot, is you do a stock correlated with the ETF sector it's in. That's a really good way to do it. Or stocks with momentum, and this is how I a lot of times will pick what to do. It's going to be based on the technicals of momentum for one stock having stronger momentum than the other stock, and they're correlated though. So you pick that stock with momentum and go long that, and short the one that has less momentum, and play that momentum correlation. Now, the next thing though is, what makes a catalyst to trigger strength or weakness? So, when you do have two instruments that are very correlated, there are certain events from time to time can temporarily weaken the correlation. And so it could be factors such as it could be a Federal Reserve meeting or something unannounced that comes out of nowhere, some geopolitical turmoil or some industry, problem that happens, could be could be asbestos to one, 3M, and another company doesn't have that exposure. So you short 3M, buy something that's correlated to it. There are all kinds of little things, but you have to, a lot of times it has to have a catalyst to break that correlation, to weaken it, right? And another really good one is earnings. That can be a really good catalyst. So you have that event that triggers the weakness, and that creates that divergence in the correlation. But they're going to be generally limited to a certain period of time. But these can be divergence that can last for extended periods of time. They can last months and sometimes even longer. Now, one good example that I like to show is that just when you have corporate raiders, like let's say, or just Warren Buffett. Warren Buffett comes out and he's buying a huge stake in Conoco or Occidental. So he buys up, 4.5 billion stake in Conoco, and you're going to see something happening, right? He's been in there nibbling on Conoco. So what do you think is going to happen? Conoco, relative to the market going down, Conoco's the relative strength is going to go up, but the correlation may be to XLE, which is the ETF sector is in. XLE may be going down while Conoco is going up, or XLE going sideways and Conoco is going up because Warren Buffett's, putting together a huge position in that stock. Now, you may not know Warren's doing it, but you can see it show up in the spread. So here's just a good example of something like that. You can see that correlation. Conoco versus XLE has a very good correlation of 0.98, very tightly correlated. But Warren starts coming in there nibbling, buying up. You're going to see that correlation shift between the two, the relative strength change. So here's just a really good example of actually that past event. So, he started buying into Conoco, and at that time, you're going to see the spread really started going up. Now, we didn't know he was doing that, but the market and the spread sure knew. So here's Conoco versus XLE. So like on the 20th of November, in this example, when it started happening, Conoco was trading at $25.39 per share below XLE. So it was down here. Here's the spread. So here's that relationship of Conoco versus XLE. So you can see the momentum. Here's my cycle reversal indicator. So this will be the indicator that you're going to get with the course. So this is your course bonus. So you can see it actually went positive right there. Here's a good example. It went negative on the reversal indicator, and that spread went down. Here it goes positive. The spread starts going up. All right. So behind the scenes, Warren is in there buying the heck out of Conoco. So look what happens. That spread goes from $25 under, basically. So one share, or 100 if you do that. to, in this situation, it went up to, on the 4th of March, that spread now is $1.85, and now Conoco was $1.85 over XLE. So huge move. So it went from 25.39 plus 185. So this was a $27.24 per share move from here to there, or if you did it 100 shares to relate it to one option contract equals 100 shares, that was a move of $2,724 for one option contract. And that's what you're going to learn in the course, basically. But look at that, huge. So think about it. This is why hedge funds make a lot of money. So, and we used to make a lot of money off the spread. So you might do, you know, hedge funds are out here not doing one share, not 100 shares. They're doing thousands of shares, you know, thousands of contracts. So they're going to make, you know, 270,000, 2 million for, you know, you can do the math. So it's a huge way to trade and very, very great because you're playing the relative strength versus the market. You know, the energy market could be tanking, but that spread is not tanking. It could be just is still moving out. Yes, the course question here. The course will teach you how to find correlated pairs and how to do the correlation calculation I'll go through every step for pairs trading, all the different steps from selection process to the pairs trading, setting those up using synthetic options, and then you know, how to track them and you know, how to manage the trade. So it'll cover all of that in the course. So yeah, make sure to use that link. Here it is again, and then use that small cap PAIR 15. So I've taught this course, you know, I don't do it very often, but it is so much fun. Of course, you can get the pairs trades wrong and lose a lot of money. I've done that too. I mean, you know, it can go either way, but when you get it right, it's so much fun because number one, you're not worried about the overall market. You don't care. Somebody can say, hey, what, you know, golly, the market's tanking. How are you doing in the market today, Derek? You know, it's going down. Well, you can say, I'm doing great. You know, I've got a spread trade on or a pairs trade. And they have no idea what you're talking about. But, you know, I'm up, you know, $2,700 and the market's going down. I'm doing fantastic. So that's what's fun about it. And I'm sure that everybody here, you have a, you know, different, you know, knowledge of different sectors, different industries, maybe things that you have, you know, worked in. And so you know the relationship. So this is a great way for you to take advantage of things that you know about the sectors and the industries you've worked in to trade pairs off of that knowledge that you have. And you can do it with very low risk and very low capital, you know, so it's a lot of fun too. You'll really enjoy it. All right, so that's a really good example. So the next thing is your pairs trading opportunities and examples. So I'll show you a couple of examples. Now this is a really cool, this is the one that we used to do a heck of a lot when I was running the energy group. We did, this was like, this might make our year. This was doing gasoline crack spreads, what we call them, crack spreads. But this was an RBOB gasoline futures contract, you know, playing the spread between RBOB and crude oil. So it's just another way you can do it. So there are commodities that you can spread. I mean, there's everything. So here's a really good example of how unique it is. So here's just the chart. Now this is RBOB gasoline, and this has been converted to barrels to make it, you know, apples to apples. Now, you know, RBOB is priced in gallons, but in this particular trade, we're going to make this a spread where it's priced in dollars. Real easy to do. We just do a conversion. You know, there are 42 gallons of gasoline in a barrel. So for each contract here, if you bought one futures contract, that's 1,000 contracts of oil. You multiply times 42, that'd be 42,000 gallons. But anyway, this has got the conversion 42 times RBOB, so it gives you the same relative value. So RBOB here is trading about right here. It's trading in this example. It's trading right about $70 per barrel, right there. RBOB right there. Now, this is another thing with my indicators, pretty cool. You can see RBOB is actually in a what we call a volatility squeeze. Look how tight it is. It is just coiled, wound up, ready to either go up or down. Now it goes explosive move to the upside, really big move here to the upside. Now here is crude oil at the same time. Just look at the difference. So crude is also in a volatility squeeze, but look what it does. It goes up, and then it just kind of really, it still goes up, but doesn't go up as fast. This one is really, really steep moving to the upside. Crude is just, kind of lagging a little bit more, not as quite a sharp move. So at this point, RBOB gasoline relative to barrels, we converted it, was going at $70. And at the same point, crude oil was trading right here at about 55.40, right about here. Okay, so now let me show you what the spread looked like. So here's doing that spread in that relative value of barrels to barrels. And so here was a really great example of a spread trade. Here was RBOB gasoline minus crude. And that at that point, we had RBOB on the 8th of February. This spread relationship was trading RBOB at that point was $14.60 per barrel over WTI. It was right here. Okay, right there. That was the spread value. Now you can see also my indicators. We had cycle reversal here, so we had that spread. This was on that spread. We had good momentum, but that spread started shifting and moving to the upside. So this was a daily chart here, and here's a weekly chart just to kind of show you on the weekly. So the weekly had a cycle reversal, etc. Now the spread went then from $14.60 over, gasoline over, to now the trade was gasoline blue to $22.50 over. So you had a move here from $14.60 where it started to $22.50. So that's a move of $7.90 per barrel. Now remember, one futures contract's equivalent to 1,000 barrels. So you take that $7.90 per barrel and convert that with futures. So if you'd done one contract, if you went long, a contract of RBOB, short a contract of crude here, one contract, that was now worth $7,900 right here. Okay, so that just shows you another way. I mean, there are just so many different ways you can do these types of trades. So there's so much fun. Now the course is going to be more focused and concentrate on equities, equities to ETFs, equities to equities, okay? But, if you come in, you want to look at some special commodity, we can look at it. Now, the next thing is, again, you kind of call offense, defense. Here's a really good example of QQQ relative to the Russell. I mean, the Russell has just been a dog. Now, here's a great example of if you do a pairs trade where you could be long QQQ or short QQQ, first thing you do is the correlation. So just looking at the correlation between the two, there's a good correlation, 80.81. So good enough correlation, but look at that spread difference there. Look at these spreads, how they widen out, right? So here they're really tight, then they really have a nice, widening move. So a great one to do, and they're very liquid. So here's a good example. Here's QQQ relative to the Russell 2000, and you can see this is more dollar weighted. Now the other thing in the course, I'll teach you how to do the make sure you're more dollar equivalent, so you can do the number of shares that are equal value dollar wise or closer to that. So we'll go through how to do that to make sure you're on the same page there. But here it is, with that relationship where they're more dollar related. So at this point, QQQ was trading at $76 below the Russell. Okay. How long are these spreads for? Well, here's a good example. Here's a spread here, Audie. Look, this one started on the 6th of March. This is a good example, good question. Question was, how long are these spreads usually for? So really great example right here. So here was the March, early March, and then look at the spread. It trended all the way up here, and this was all the way to June, right? So you can see that one. I mean, sometimes they go even longer than that. Okay, so that's a great question. And so here's that spread between QQQ, and then QQQ started gaining value relative to the Russell and ended up up here now it was from 7,600. Now it's 1630 under. So pretty big move, okay? So here's your cycle reversal indicator. You'll get this with the course. It's one I use for these spreads. I designed this indicator actually for spread trading, but we use it for everything now. And then look at the momentum. If you want the momentum indicators, you can get that too. They're really helpful. If you want to add those to your cart, those are $195, but they're really going to be great addition if you don't already have them. So you can see how that spread blew out, right? And so here's just, you can see it. This is a 4 hour. I like to use that kind of combination a lot of times. Here's the 4 hour with the daily. You can see the cycle reversal here. The momentum starts to shift, and that spread really starts to move. All right, so that's a really good spread movement there. Now, here is if you're looking at just the two securities by each other, a lot of times it gives you a good idea of how these work. Okay, so here's QQQ. You can see right here where it's coming from. QQQ is getting a cycle reversal, and it's starting to really move hard. But look, here's the Russell. Look at the Russell at the same time period. Here's QQQ. Okay, remember these are pretty closely correlated, about 0.81 correlation. And look at the Russell though, it goes straight down. That's perfect. QQQ going up, Russell going down, playing the spread. You don't care if the market's going down. That was fabulous. So you could just trade QQQ and Russell and probably just do that alone, and just that's what a lot of hedge funds do. They'll just be specialized in certain things. They'll have a trader and all he does is trade QQQ, Russell, or something like that. But look at Russell goes sideways, does nothing. So here's the math to give you a little bit more clarity on how this works. So here was like if you went long QQQ on the 6th, this is just QQQ. It was trading at $302. All right, now on that same time, at that same date, the Russell 2000 IWM was trading at $1.89. All right, so but we want to make this dollar equivalent to make a little bit more apples to apples. So we're going to be long or short 2 Russells. So if we did that, the value was 378. All right, and you can see here that QQQ was 302. All right, so you can see that difference, the spread difference between the two. So if you take 378 and less 302, here's your spread, $76. So QQQ was $76 under the Russell. Now on the 19th of May, now QQQ was trading at 336.20. So it was up $34.20 per share. Had a nice move. It was going up, but what was Russell doing? It was going down. Look where it's trading. When you first, started with the Russell, it was trading at 189. Now on the 19th of May, it's trading at 176.25. It actually went down. Now adjusting that for dollar value, that was then trading at 352. So you can see it went from 378 to 352. So it was actually down. This should be down $25.50. Okay. So then you can look at the share price. The value of the spread was 352 less 34.20. Now that spread value is 1630. Okay. So that's what you're playing there. 352. Let me make sure that's right. Yeah, 352.50, and QQQ was trading at 336.20. So there's your spread value there. So all you're trading, you don't care about, when you're doing these spread trades, you don't have to look at the price of the share. All you're looking at is the spread relationship. So that spread went from 7,600, now it's 1630 under. You just made, $5.90, or per 100, you made $59.70 per share, or per 100, you're up 5,970 per share, and you don't care where the markets were going. You can look here again. We back up, and you look at this chart here. Look at that. You don't care that. Look at that, perfect. That's beautiful. So, whatever industry you're in, you might know some of these things that are so correlated that you think are going to happen, and you could make a lot of money. So that's pretty much it. Now the next thing is, again, I had a question, how do you find them? A lot of times I'll scan. I've got a scanner set up that I can look through And I've got a lot of the different pair correlations set up together. And so I'll look through my scanner, I'll scan through, click through and look to see what I can find. That way, that's a really good way. Like, for example, here's Costco, Walmart. I was talking about this one earlier. And you can see here's Costco to Walmart 1-to-1. And you can see that spread relationship. Here's the cycle reversal indicator that you're going to get with the course. But look at this. And again, I designed this indicator specifically for spreads. Look at this. So here's the reversal. So here's where Costco started to reverse. So it started signaling a reversal in its spread relationship. Now these are very correlated, tightly correlated together. So right here was a place where you could start going long right in here, Costco, per Walmart now. And then you see my momentum started to kick in, and it finally turned the corner. Look at that. Beautiful, perfect. So the first thing I look at is this is my signal to a potential change in cycle, the cycle being the spread between Costco and Walmart. And then my momentum indicators confirm that Costco has enough momentum to create that spread to widen. So then you can see momentum starts to shift here, and then look at the spread. So at this point, that spread was 825, and now look at the momentum. It starts to really, really build, and you can see now the spread was up to 950. So this went from 950, just kind of roughly looking at it, $950, and that's all you're playing. You're just playing the spread. You care less about the market, so that's what's so fun about it. You don't have to care about the market. So this went up just on this relationship. That's $125 move between the spread from here to here. All right, and then you can see here, look, cycle reversal. Then if you want to go the other way, look at this. So then Costco started, falling apart and moving lower relative to Walmart. So in this one, you could just do the opposite. You could either go short Costco, long Walmart, or be long Walmart on the spread. Either way you want to look at it, short Costco. Look at that. Look at that move. Isn't that awesome? And look at the cycle reversal and the momentum. So, I mean, that's what, you look for. And, that's a really great example of how these can, be utilized. Here, just flip through a couple others. Let's see if we see anything here. Here's like QQQ versus Apple. Nothing really standing out. Here's Microsoft versus QQQ. Here's a good one. Look at this. Look at that cycle reversal. So you would be long Microsoft, short QQQ here. Look at that. That is awesome. So again, like I said, these are so much fun. Anything you want to look at, any spread, I can plug it in pretty quick. Here's Tesla versus the sector, ETF sector it's in, XLE. Look at that. Look at this. Look at that back there. That was back in October 2024. Look at that spread. It went from 38 to 235. Unbelievable. Look at that. Wow. Is that, I mean, like I said, these are just exciting, breathtaking. So let's say it went to 40 to basically 240, 240 from 40. Gee whiz. $200. So if you did one share, $200. So I think you get the picture, right? So just a lot of different ways you can do it. How about pairing CONY with fiat, QQQ with PSQ? Okay, let's take a look. There you go. Here's Coney. It's trying to turn now. That's that one. The other one you want to look at was QQQ, PSQ. This one had a big move down. Here's PSQ. This would have been an awesome trade right there. Look at that. Stock reversal. Look at that. Breaks out. That was good. Good one. Yep. Here's Palantir versus its ETF, IGV, right here. So you can see long term. Somebody asked how long these can last. Let's go back and do a weekly. Look at that. These things can last a long time. Here's Palantir. I never say that right, but here's on a weekly, long term. Look at that stock reversal. Look at this. Went from 60 under to 7 over, so about $67 move there. Anyway, these are so much fun, exciting, and can be just such a game changer. Hopefully, you guys and gals will definitely join for the course next Saturday. I think you're going to get your money back and then some. So again, there's that link again, Ben. And then pairs and synthetic options. So we're going to go into, doing these type pairs trades using synthetic options. Now, a synthetic option pairs trade does a combination where combines the power of your pairs trading with the flexibility of options strategies, allowing you to replicate the movement of a higher priced equity, but using options to lower the price of that equity. I mean, think about some of the equity. Costco trade is over $700 a share. So, think about doing a pairs trade with Costco where it's you have to buy Costco at 700, Walmart's, 80, so just kind of think about that. But we could do the same trade with a much lower equity cost by using options while, hedging the risk and reducing our capital exposure. So the capital exposure is lower. Your returns are huge because of that leverage, but your risk is just the same as if you went long Costco shares, short Walmart, but at a lot less, a fraction of the cost. So instead of buying and shorting expensive stocks outright, we're going to use options and we're going to create a synthetic long short position that replicates the exact relative performance between the two equities, or equities and securities, or futures. You can do it with anything. So the strategy basically is going to lower your cost of entry, reducing your capital at risk, built-in hedge for directional and overnight risk. Your hedge, you're mitigating the any overnight risk. Okay. I'll show you how to set up your scanner. Question is, do we get a scanner? Yeah, I'll show you how to set up your scanner. Yes, you'll get the scanner. Okay, you'll get that. It gives you the flexibility to profit from price divergence, not just market direction. So again, I keep coming back to, that's why I named this course, basically you're able to sleep at night. All you care about is that spread. Is very scalable, for the market. So just all in all, a great strategy, and it's so unique. And I'm surprised. I'm probably one of the few people that teach this course, but I only, actually do it once a year. I probably should do it more. So it's a really smart tactical approach that combines market neutrality with strategic leverage, designed for traders who want an edge in today's unpredictable market. And I would say that's highly the case, right? So again, that's what really thought that when I did want to do this course, I thought, man, this market's so damn crazy from one day to the next. But the better way to trade it is, using pairs. So here's a great chance for everybody here. Hopefully you'll take advantage of this offer. So let's take a look at how we can pull this thing together. So today was just the beginning, an introduction to what I think is one of the most powerful yet often overlooked strategies for trading equities, okay? So if you're ready to take the next step, learn how to combine this unique pairs trading strategy with options using synthetic options, which are really cool. And this is the course alone by itself. This is just high value stuff to replace the high price equities and reduce your risk. Then join me next Saturday for the next level of training that will unlock this potential of this kind of game-changing approach. And it really is a game changer once you understand how to do it. So let's keep the momentum going, and your edge to start here. So again, here's that link. Make sure to take advantage of it. Click on it, put pair, PAIR 15 small cap, and get started on this really great way to trade. So here's let's go through the course and all the stuff you're going to get, how it works. So again, thank you so much for being here, but let's take some time to go back through the course here, what you're going to get. So this course will be next Saturday. We'll start 11 a.m. Eastern, so Pairs Trading Playbook. So how we're going to neutralize the market and maximize the edge to our trading. So it'll be a 2-hour plus course, however long it takes to get through all the material that I'll be covering. And it'll be using pairs trading though with synthetic options to do the actual trades. So you'll get the live course, plus we'll do, everything will be recorded, broken down in modules, 30 minutes or less, plus the training manual handouts. And there are also 4 bonuses that come with the course. So use that powercycletrading.com/special. So with the course though, I want you to use we're going to be using this indicator. So you may already have it, but in the course, I never have really used the indicator. I'm not, in the trade room to show you how to do it with spreads too much, but we'll be using this pairs trading cycle reversal indicator that I originally designed it for. So you'll get that. If you go to my website, that indicator is $197, but this is going to be part of the course. We're going to use it. So you'll get that as a bonus. So you'll get that, plus you'll get 30-day trial membership to the club. You can start when you want, and this will give you access to my trading room. I'll go through that in a minute. I do overnight videos of the market every night. You get access to that every day after the close. Trading room every day during the week. So if there's a pairs trade, you can come in and talk about that or other trades. We'll do a live follow-up Q&A, and then you'll get my futures commodity guide. So you may even want to do these pairs trades on futures if that's what you like. You can do those on futures as well. So you'll get all that, and so all the bonuses are over 700. So total package value today, $1,900 basically. And if you use that link, pair 15, it's 167. Now, when I go out with the course next week, during the week, it's 197. So if you want to get that 15 discount, make sure you apply it here, okay? So that's what you're going to get. Now, if you do want package 2, so this a lot of people will want to have my alerts. So this will give you access to the course. You'll get everything in the course. If you do this package, you'll get all that stuff in the course. But you're also going to get, my special trading alert package, which is my 5 different alerts that I send out depending on the market conditions. It could be a butterfly, condor, calendar, whatever, or you can do it the way you want to do it. You just want the trade, and you'll get this for the next 4 months. Plus, you'll get my trading club, where it gives you access to my virtual trading room every day during the week, nightly videos, all that good stuff, discounts. You'll get 60% discounts on all my courses and software on my website. So you'll get this for the next 4 months. You could stop and start. You can do that by yourself. So if you go on vacation or something, you want to stop your time, stop and start it by yourself. So you get 4 months to that. And so you'll get access to, I send out the trade. And again, it could be a long condor or butterfly, but a lot of people just want to do their own thing. They may just buy calls or sell or buy puts. They're just looking at for directional trade. But when I send it out, I do it with an option trade to keep it, really low risk for you if you want to do it. So it might be a butterfly or a condor that I send out, depending on the market conditions. Last week we did actually a condor right towards the end of the day on Walmart. Or it could be a calendar diagonal, or it might be a butterfly or a calendar option pinning trade for kind of a pin trade. I'll show you some examples here later. or it could be a breakout reversal. So it could be just a straight debit spread, or it could be a credit spread, or we're in earnings season. So it could be a selective earnings trade. So we did last week, we did an earnings trade on JP Morgan. So, just depend on what the market's given us is what I will send out for the alerts. And again, then you can do it your own way as well, but that's what you'll get there, plus everything in course package one. So you'll get everything in package one. So all that, and you just get that discount if you do it today. Next week when it goes out, it'll be $597. Today it's $507, plus there's a 2-pay if you want that. Plus don't forget, if you want my momentum indicators in my other, that 195 gives you 5 different study sets that I have in my indicators that you'll get for a super low price. But again, selective butterfly condors, counter diagonals, butterfly pinning trades, breakout credit spreads. So whatever the market is showing me, that's how I then select the option trade. So when I send it out, you get a trading guide for the trade, how to set that up. I'll do a video review of the trade at the end of the day, so you'll know, what I was thinking, why I did it. So you'll get that. TradingView is good. I don't use TradingView. I use Thinkorswim, but TradingView is good. The alerts will go out by my service. I use Telegram. Let me show you what that looks like. It's a free service, and I'll show you some examples here in a minute, but it's a free service, so you can get that. Here's a look there. Here's what we did on Friday. We did a Walmart trade I was telling you about. So this goes out, by Telegram. It goes out within seconds, so you'll get that. This, and I'm constantly updating any trade. We had a trade on Palantir. We had a Boeing trade. We had a earnings trade on actually it was Abbott. And so, we had, these are, all the different trades I might send out. So those are on the service Telegram. All right, so that's what that looks like. Then the trades are listed and archived. Then we do a weekly live Q&A every week, which is live and recorded. You'll get that for the next 4 months. Weekly daily video newsletter. So every day after the close, I do a video newsletter on what the markets are doing, what's my outlook. Access to the virtual trading room, which is a big thing. That's every day during the week, 9:30 to 10:30 Eastern. And then on anything on my website, you can get for a discount. You'll have your members code, and you get a discount of 60% off on anything I have. So if you go to my website and you want any of my software, you just click on software, and then you can see here, you can come down and see everything I have. So I've got a breakout volatility scanner if you want that. You'll get that for the members price of, $397 less 60% off. So you get a members code, and you just put that members code in right there, promo code. So once you're a member, you put that in, that'll knock that price off by 60%. So all my different indicators are available to you, at the price here on the website, less 60, or it might be a course that you want. Most of my courses are pretty much option related. So you just go here, trading courses, and I'll show you all my different courses. Get started trading options, the ultimate option guide course. These are all very, very recently done. So you might want this ultimate option course. It's $597, but you put in that promo code. Once you're a member, put in that promo code, you'll get that for 60 off. So that's, a big benefit as well. So you get that. And then again, here's just the alerts. Just go through a summary there. We, since I started the first service back in 2018 through last week, we've had 857 closed out, 620 winners, 58 break even, 179 losers. So we're almost about back up to 80%. We're just a little shy of 80% now. Again, these are unaudited, but just summary of the trades. So that's just to give you an example of what you're going to be looking at there. I try to keep these low risk, high probability trades. That's why we have such a good winning rate. And again, make sure to put in your promo code to take advantage of either today 160 on the course, or if you want the alerts added, 507. Okay. And you can see there if you have the course. Now, again, the bonuses, a lot of people say, well, I've already got this, I already got that. The course value is really the course. It's $197, but you're going to get these additional bonuses because I think these are things that will help you with the course. So, one is the indicator, which is what we use to help us, identify a trade, a pairs trade turning. And the other one is, futures, how to use futures if you want to do that. So that's a reason there. Now, here was Lee who took the course last time I gave it. This was over a year ago. So this was an amazing course, Larry. This stuff I had no inkling about. It's like a graduate school course. Nobody else talks about it. This kind of trading. So yeah, it is, Audrey. So anybody here, anybody else out there teaching pairs trading? I don't know if they are or not, maybe. I don't go looking around, but here's just kind of a quick review of what we're going to cover. We'll go through how pairs offer you one of the safest ways to generate consistent returns, whether the market's up or down. That's the biggie. That's the biggie. How to put the odds in your favor, taking the worry of market fluctuation out of your trade. Another big one right there, right? The best strategies for pairs trading to take advantage of. You're going to learn the best, how to identify maybe some of the better sectors to maybe look for trades. I'll show you how to do, be watching sectors, how to set your list up there. How to identify and select the best pairs. Might be two stocks, might be a stock and ETF, could be futures. And I like to use my cycle reversal with momentum, so we'll use that. Using the cycle reversal indicator and momentum indicators to help identify the direction of the pairs trade, where it's going to go. So like I showed you earlier, we had a cycle reversal, momentum, and the spread started widening. So really helpful for those. The scanner, I will show you how to set the scanner up. I didn't add that to the, hold on. Now I'll be using Thinkorswim, so I'll be, showing you how to use the scanner with, I'll show you how to set the scanner up with Thinkorswim, okay? And so that'll definitely be covered in the course. That'll be a big part. So you will get that. Make sure I'll add that to that course page. I should have put that in. Hold on, to make it more clear. So yeah, I'll put that in here. So I just did not, but I'll update this to put that in. But you'll get we'll go through and I'll show you how to set the scanner up for Thinkorswim. Wealth charts, I don't use wealth charts, but you can I can probably help you on it. I do have the indicators for my indicators for wealth charts, but I have not, gone into wealth charts to set up a scan. But I can pretty much probably show you how to do that. The JP Morgan earnings trade went great. We did a iron condor credit spread on JP Morgan. It worked out great. Yeah, so the question, okay, so does that answer your question on the scanner? Well, you can use the indicators, okay? So right now I'm going to use Thinkorswim. So if you've got other platforms, I can't really help you on those, but I can help you at some point. But you're going to get my indicators for the reversal indicator. Let me show you here in a minute. Will be for Thinkorswim, TradeStation, and TradingView, and the scanner will be for Thinkorswim. Okay, but I can probably help you with the other platforms too. But those are not the ones that I typically every day use. If you understand what I'm saying. So I don't. Okay. And believe it or not, I do a lot during the day. So, there's a lot going on here, to be honest with you. So that was Lee who took the course. And then, you're going to get, learn how to use all this, how the statistical measures, what I use for the trade correlation. So you're going to learn how to do that, use my resource that I use for that. So step-by-step pairs trading techniques. These are, basically how hedge funds operate, basically. And, again, I ran a pretty big trading group, one of the biggest in the world for 10 years for energy. And I, worked at some other hedge funds as well. But this is, they're all doing these kind of different type of, pairs trades. They all use different type of technical indicators and things like that. They're all different, but the basic concepts is same, you know, looking for those correlations to break down and then come back together. So this will end up, you know, by doing it with synthetic options. The other big thing is you don't have to borrow shares to go short. And you're going to learn how to instantly lower your trading costs using synthetic long short pairs trades for your trades in this course. So you'll get my, you know, kind of proprietary formula that I use to help set up and identify the probable pairs, how to scan for the pairs. Now, again, I'll be using Thinkorswim, but I'm pretty sure once I show you how to do it on Thinkorswim, you'll be able to set up your own scans on some of the other platforms. Okay, and then the final thing, how to execute the pairs, the tools used, and what are the statistical resources that I use. So, you know, one more thing is, you know, research has really shown that we learn the most from experience a lot of times, right? The experience of either being right or being wrong. A lot of times you learn from your mistakes, and those are the ones you remember the most sometimes. So not just study, not just the textbook. So by combining this comprehensive course and my experience doing this and the additional support I'm going to give you, you'll be able to take your own trading to a really new level. And also, I think this is going to be exciting for you to learn. All right, so the enrollment bonuses. Now, here's the cycle reversal indicator. Now, I originally developed this indicator for spreads, but then it was working on so great on everything else. We use it for everything, but it's a cycle reversal indicator that's, you know, based on a kind of percentage momentum indicator, and it's got a lower and upper study. So the main thing is the lower study here. So we'll be using this in the course. So we get a cycle reversal up. That's when we're going to look for the signal for potential change in cycle, or cycle reversal down, looking for a change there. Now, if you want my momentum indicators, which you see below, you can add these to your course package. And these are $195, and those are available for Thinkorswim, TradeStation, TradingView, NinjaTrader, eSignal. Okay, if you want those, you know, when you check out, when you check out, if you want those, they're going to be available to you. I'll show you if you're not aware. Let me pull that up. And I would, you know, obviously highly recommend that you get those indicators. Let's see where those are. Okay, so if you go here, you know, if you're checking out, you want the indicators. Thinkorswim, TradeStation, TradingView, wealth charts. The wealth charts are not going to be available on this. These are separate things, but they are also available for eSignal and NinjaTrader. So here they are. If you do want to add these to your checkout, it's basically a 5-study set. My 2 momentum indicators, another indicator, and my volatility squeeze indicator. So great package there. If you want it, just, you know, add to cart, add to your order, put in your, you know, your promo code 15, and you'll get, you know, everything plus the indicators. And these are multiple different platforms. You know, if you get them, you can, and you have other platforms, you don't have to pay any kind of additional fees. So pretty good deal. So here's what it looks like. I showed you this earlier. You know, here's the cycle reversal on Starbucks. And that's, here's just an example, Starbucks versus XLY, which is the staples, okay? So here's just a kind of example, cycle reversal, momentum shifting down, that relationship started to fall apart. Anyway, so that's what we're gonna use in the course, so that's why I gave it to you as a bonus, okay? And then the other thing, bonus 2, you'll get my 30-day trial membership to my trading club. Now, you can start this after the course or whenever, but you'll have 30 days. And then if you do want to renew, it's $97 a month, and we have then other packages as well. But basically what you get with my trading club is you get the big nice things, my access to my virtual trading room every day during the week, 9:30 to 10:30 Eastern, okay? And then, you know, if there's a pairs trade you want to come in, look at, anything you want to come in and talk about, or what we're doing in the room, you'll see. Then I do a daily video newsletter, you know, after the close, looking at what the markets are doing, my outlook on that. trading video archives and different things. We archive our videos. Then we do a live weekly Q&A every week, which is also then recorded. We have a trader's educational vault for the members, and then that discount of 60% off all courses and software. So you'll get that as a bonus. And here's one thing I always like to point out. This one from one of my members, Jay, said, reading books is fine, but seeing the actual option trade setup makes a huge difference. You know, and that's a really big plus. That knowledge and experience will help you a lot, I think. So you get that. Bonus 3, we'll do a live follow-up Q&A, which we're going to do that on Tuesday, so everything's fresh in your mind. Plus, remember, you get 30-day trial membership. Now, if you do my alert service, you'll get this for the next 4 weeks, right? And you can stop and start when you want. 4 months, I mean. And then you're going to get my futures trading commodity guide, so kind of blueprint guide on what you need to know about trading futures. And then if you do want the elite open and close alert service, you'll get that, and we'll go through a couple of trade examples of what you can expect on that. So yeah, synthetic. So question is, sorry I'm late. Can you please define a synthetic option? Yeah, so what a synthetic option, I'm gonna teach you in the course how to structure, instead of going long, say, QQQ or something, with the QQQ, or say it's going long Apple, I'm gonna teach you how to replicate that using pairs, so an option. So you're gonna learn how to do that rather than pay whatever say Apple's trading at $180, rather than paying out $18,000, right? If you were to buy 100 shares, it's 18,000 or something. So in the course, you're gonna learn then, instead of buying the shares, the underlying shares, we're gonna do that using options. So if we do that with options, this will be probably 1/10 of the price. So it might cost you, $200 or, something like that, just for example. So it's a fraction of the cost. So we're going to do that, but we're going to show you, show you that if Apple goes up, the way that we'll construct the synthetic option, the long, it's going to go up, the option is going to go up exactly pretty much neck and neck, replicating the long. Now, we're going to be doing pairs, so we're going to then also, you're going to learn then how to short, instead of having to borrow the shares, let's say, and short those shares, we're going to do it with synthetic options, where it'll also be a fraction of the cost. So we'll have a synthetic long with the option, and then we'll have a synthetic short. So we'll have the pairs trade. Instead of with the underlying securities, we'll be using options to have a fraction of the cost and a lot of different, more efficient. All right, so it's a really, really great way to do it. It's pretty cool. I think you'll like it. Here's order form 1. Yeah, here you go, Ann. So we're requesting order form 1. Let me pull that up. Now again, in the course, I'll show you how to set up the scan, and I'll be again using Thinkorswim to make that clear. Okay, so here is basically what you're going to be getting. Stock reversal indicator, 30-day trial membership, follow-up Q&A. That should be futures trading tutorial. Prices, when I go out next week, it'll be 197. If you sign up today, it's 167, 15% off. And so you want to use then to place your order. You come down here, just click on that buy. Now again, if you want to add my indicators to your package, you can do that. And then it's should clear that out. It's 195, and then you come down here and you put in your promo code PAIR15. If you just want the course, it's it'll then end up being 167. Okay, so that's how you do that. Okay, does that answer your question, Ann? Yeah, a synthetic option is just an option, but no, but it's not just buying calls. If you want to go long, it's different. Okay, it's a little bit. It's not complicated. It's very simple, but it's just a different. You're not intuitively you would think, okay, if I go long short, I'll just go buy a call, and then I'll be long. Or if I want to be short, I'll just go buy a put or I'll sell a put. It's a combination of things because you have another thing that's going to affect your position is time value. So there's a way that we do it to offset that. So you're going to learn how to do that, and which is a really cool way to do it. So we'll do that for the long and we'll do that for the short. Okay. And there's order form 1. And I've been, doing these for, a long time. So it'll be something I think you'll really, it'll really be pretty interesting for you to learn. So here's the alert search, just a little feedback. Here was, one of my members that signed up said, Dan, he said, you're in the service, you're very diligent, totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades. A lot of people will, pay for their subscription with the trades. They're just going to learn as they go because I outline and I'm pretty detailed when I send out the trade on the, the option trade, how to do it, stuff like that. I'll show you some examples. So I took that with you when I was learning how to trade options. Please feel free to share this with other participants if you wish. And then Scott said it'll be the best investment that you'll ever make. Go with the Elite package, great group of traders. Appreciate that. So when I send this out again, there are a lot, my trades are very, very selective. Okay, so longs and shorts, whatever. So when I do send out a trade, there are a lot of members that then just do their own thing. Okay, they just, if I'm going long, they'll just, buy calls or whatever. Maybe they'll sell puts or they'll go long the shares or go short. They'll, do their own thing. But when I send out a trade, I will always give you an option, suggested option trade to use with it if you want. All right. Because I like to do options or spreads as well to lower your risk and also to increase your return on your lower capital. So I'll give you the entry price when it's sent out. I'll give you targets. And so my targets are based on what I call price target mapping, Fibonacci, other stuff. I'll tell you what option series to use, stop loss levels. Then I'm constantly monitoring the trade throughout the day, sending alerts if you need to know something. Trades are listed and archived. So there's a lot that goes into each trade that I send out, and I follow to the bidder end. So then I do at night after the markets close, I'll do a video review, if that trade of the day that I did, and that will be in the video review with the newsletter, the video newsletter. And then we do live weekly Q&As every week, which are live and recorded. So you'll have that. And then again, the big thing is the virtual trading room. You'll have access to every day during the week, 9:30 to 10:30 Eastern. And 6% discounts on everything on my website, courses and trading software and the Trader's Educational Vault. So here are a couple examples, and these are butterfly long condors. Now we've got started this service back in May 18, 2019 through last week. We've had combination of butterfly long condors. We put out 219 trades, 158 winners, 16 break even, 45 losers, running a 79% win rate. These are big potential return type trades, either 2 to 1, sometimes even 25 to 1. I'll show you some examples. But the risk on these are super low, kind of average about maybe, excuse me, $7,500 because they're either a butterfly or a condor, but they have a really good positive risk ratio that you can use, okay? So, which I really like. So here's just a couple that we've done. Here's some examples of what you can look for. Here's one that we had on IBM, we put condor. And so you can see they're very, when I send it out, they're very descriptive. So it says new IBM short, okay? So if you were, let's say you wanted to go short, you didn't want to follow my trade, my option trade, well, maybe you said, okay, I'm gonna go short, I'm gonna buy puts, or maybe I'll sell a call credit spread, whatever. But if you want to follow my trade, I always send out the option trade. So here it says trading, here's trading at 246.45, it says daily. I'm trying to describe the reason I'm doing the trade in a short amount of time, because these go out pretty fast. Daily cycle high retracement reversal up to 21 exponential moving average. Daily negative momentum. These are used by momentum indicators. Downside momentum across another indicator I use. Target 1, 240, target 2, 235. Buy condor. So I tell you, do that. Boom, 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 at around 75. Okay. So that was the trade. Now here it is on March 21st. Now it's trading at 242. Okay. So I send out an alert, say, take profit today, max profit today on a close between the spreads, currently up around $160 per spread, or 228% return, market, fast moving market, etc. So, these things go out with Telegram, and they go out as soon as I send them out, they're out. So here was the trade that we did on IBM. You can see that the 4-hour, these are based on my indicators. So we were getting a short trade set up here, right there, and we had negative momentum without going through too much cycle reversal. Here's the reversal indicator that you're going to get with the course. Now these are just used for trading stocks, etc. And so here was the trade that we sent out. This was what we call a put condor, so very low risk trade. So we were long the 245, put short the 242.5, and then short the 235, 232.5. Put credit spread. Okay, so $2.50 wide spread. The trade cost was 70 bucks. That was our risk, $70 per spread. And so potential profit was the difference, $180 per spread. So if you did one spread, you can make 180. That'd be a 275% return. Okay, so very low risk trade, but you can do your own thing. You don't have to do this trade. Some people, again, just want the trade. And so here's where it went out. It went out pretty close to max profit on this trade. So this was an alert trade that was sent out, and you can see it was trading at 318. It was 246. Then on 321, it was trading at 242 down here. So really good trade. So the spread went from 70 bucks to 228 bucks. So $158 profit per spread. If you did one spread, if you did 10, $1,500, 225% return on a very low capital at risk. So that's what I'm trying to achieve, for my members when I send them out. Here's another one, we did recently. Here was on SPY, a long put condor. And again, here's the trade setup when it's sent out. It was very descriptive. It says new SPY reset short. We've shorted this a couple of times. This was getting back into it. Buy the vertical spread. So what we did here, we bought the vertical put dev spread, and then we added the bull put credit spread to create a put condor. All right, so just adjusted this to a long put condor to reduce risk and make for a better potential return on our capital. And so then you can see on the 11th of March, now it was trading at 258, so it was really pulling back. And so I sent out an alert. I said, here, I'm constantly updating. Said all spreads will expire today with profit currently up around $205 per spread, or 476% return. Then a little bit later, I sent out another update, trading at 558. If long the adjusted put condor at this price, current level, close the trade out will be max profit around 257 or 597% return. All right, so this one was just worked out, was a killer trade. So here was the trade setup, out the next day, in at 568, out at 556, basically. So did this put condor. So this was actually ended up about a $300 wide spread. So we had to put debit spread here, a bull put spread here. So that created the condor, which looks like that. Total risk, 43 bucks when we did that adjustment to the condor. So potential to make 257 per spread, 597% return on 43 bucks risk. I'll take that all day. And we made pretty much max profit. So it went out exactly, between the two spreads here. So $300 wide spread. It went from 43 to 300, 257, 597% return. So that was pretty cool trade on that. Now these are really fun. These are the other types of trades that I might send out. They're very selective. And this was what we call our lotto trades. Here's one that we did not too long ago on NVIDIA. I'll kind of flip through these. This was back in March. Now, this is a trade that we set up on NVIDIA, and we're looking for potential pin. So this is what I call binary monthly butterfly pin trade. And we set this up on March the 12th. It was trading at 115, and then on the 20th, it was trading at 119.66. So we had the spread went from to $131 per spread, so we were up 503%, potential 503% return on that trade. So anyway, very descriptive on the trades. So this was a butterfly that we did, said to do this trade if you wanted to, and put in around 30 cents or $30, okay? So now it was trading on the 20th, now it was trading at 118. So the butterfly was up $85 per spread, 326% return. Then the same day, a little bit later, now it was up towards the end of the day, $131 or over 500% return. So because the risk was so low, had a great return. So this was the butterfly that we set up, targeting this upside move here. Here's the trade setup. Just kind of go through what this looked like. So we started the trade, it was trading here. So we did a 118, 122, 126 butterfly. Total risk on the trade, $26. Potential profit, $4 wide spread. 400 less 26 potential was for 374. So potential for over 1,400% return. And we didn't quite make that, but we still had a great return. So it went from 26 bucks to 157, up $131 per spread right here, or 500% return. But the big thing was 26 bucks. And this kind of crazy market, those are good trades or good risk. Now here's the one we did recently. This was a really good one on SPY. This was a put butterfly that we did, and you can see it says new SPY pinning trade. It was trading around 573.80. Doing a butterfly here, so doing a 565, 60, 55 put butterfly. I said do it around 40 bucks. So when I say round, that means okay, 35, maybe you get in at 30, 35, 40, 45, around that area. So the debit paid will be your risk, butterfly, etc. So here it was on the 10th. Now it was trading at 567.63. And I said, go ahead, look to take profit today on any move towards 560. And then later in the day, it was trading around 561. I said, make sure to take profit today, close trade out prior to close. Currently up $232 per spread or 595% return. All right, so these are the alert texts that you'll be getting if you do this service. So shorted here, got out here, and here was the trade setup. It was doing a put butterfly 165, 160, 565, 560, 555, $5 wide spread in for 39. That's the total risk. Potential to make 461. That'd be 1,183% return if it had max profit. And this one ended up pretty close right there. So this now we're scaling out. We want we'll scale out, wait, and try to leave some for the close. But typically, I'm sending out alerts to take a little profit. And then if we can save some for the close to see if we can get the max winner. So this is it right going in towards the end of the day. So it went from 39 up to 456. So the spread at that time was up $417 per spread. So that was up over 1,000% return, that final leg there. So just a really cool type of trade. So these are just the different ones I'll send out based on different conditions. And here's one of the most amazing ones ever. This was on a Tesla. We did this one. I'll go through kind of quickly. I know everybody's probably ready to roll, but this was such a cool trade. We did this. This was back in February. This was Now this was last year, not this February, but I sent this out. Uh, Tesla binary monthly butterfly pinning trade. It was trading at 189.35. Trade set for potential monthly expiration pin at 200 next Friday. So I said buy this butterfly. So it was a $2.5 wide butterfly for $12. Okay, so it was super cheap when we got it. And then on the 16th, now it was trading from $12. Now it was up to $215 per spread, over 1,700% return. And then at the end of the day, now it's trading right at our penny price, 200. So it's up over 1,900% return. So these are, returns that are possible doing these types of trades, which I do send out. So enter was here, getting out there. Here was the trade setup that we did for 12 bucks, super cheap, 197.5, 200 to 202.5 butterfly, 12 bucks. That's what I sent out. 12 bucks spread cost, spread with 250, potential make 238. That's a 1,983% return. If it pins at the butterfly top, and boom, it did pin. So this was, at the end of the day, this was max profit. Again, we're scaling out, but that's where it was right at the end of the day. So it was up $238 per spread. That's 1,983% return. So really cool, setup there. And then the calendar, we do a lot of these. Lately, we've been doing more condors and butterflies because of the volatility, but these are some that we do a lot of these. So you can see the performance here has been really good. We started this back in June of 2019. We've had 328 trades close out, 237 winners, 20 break even, 71 losers. We're at about 78 win rate, unaudited, just a full disclosure on that. And here's, we haven't done many of these lately because the market, like I said, is so volatile. Here's one of the last ones we did. It was a really good one. This was on CCJ, and so we went new CCJ long. You can see it says trading here, 53, daily cycle low, retracement reversal off 200, breaking back above 21, daily volatility squeeze, positive momentum with a 4-hour upside cross, target 1, 2, buy a diagonal. So here's the trade setup, find that 7 February, short the 24 Jan, 53.55. We did a couple adjustments, making the trade better. So, now it's at 54.80. Did an adjustment here. I won't go through the detail there, but then here it is on the 24th. Now it's trading from 53. Now it's trading at 58. And now we are, if long the adjusted condor, currently up around $282 per spread or 151% return. Make sure to take some profit. We'll adjust today's. So these are, kind of things that will be sent out to you, all during the day typically. And so here's CCJ, entry, adjustment, exit. And here's kind of the profile of the trade when it went out. So got in the trade, we were in at $1.86, adjusted cost was going out up at 483, so we were up $297, 159% return. Okay, so I just kind of wanted to, if you wanted the alert service to give you an idea of what you're going to get, if you do, sign up for the alerts. And here's one last look. Make sure to use that link I gave you right here, PowerCycle, www.powercycletrade.com/special. That's all you have to put in. And then that will pull up this drop-down link and use that to select your course package. So again, just to make sure, we will set up the scanner for everybody using Thinkorswim during the course, so you will get that. But today, if you use that code PAIR15 small cap, you'll get the course for next week, the live, and then we'll have it recorded for you at 167. You'll get the cycle reversal indicator, access to Trading Club 30-day trial, follow-up Q&A, futures trade commodity guide, and for today 167, and that's for the package 1. And if you want package 2 with the alerts, just use this link here. That's everything you'll get. So just one last look here. Let me put the link back in. So I'm going to just paste that in. All right, so pull that up and be ready to go. So promo code PAIR15, and there's your course package 1. So again, any last questions? I really appreciate everybody being here, and I hope this was something beneficial to you and something that you'll have interest in to learn how to do, and I look forward to seeing everybody, next Saturday. Okay, thank you, everybody. Have a great rest of your day. Here's package 1. You want package 2, it's down here. And again, if you do want to add my momentum indicators, you can at checkout by just clicking that box there. Okay. Again, thanks everybody. Have a great rest of your weekend, and I will see some of you back on Monday. If not, I'll see a bunch of you next Saturday. So again, thank you so much for being here. Have a great rest of your day. Ciao.